So
Okay.
we can have all this information to play back.
Okay. So on a VA loan, the seller, it has a 4% maximum for seller concessions, but closing cost and points are not considered in that 4%. And that 4% can be used for the remaining closing costs, if they're needed. But we can use it to pay off debt from the seller. Up to 4% of the loan. Pardon me? It's limited to a 4% seller concession on VA, but closing costs and points, marketable points, not points like 4 and 5%, but something like 1 to 2 points. But that balance of the separate 4% concession can be used towards paying off debt. I was working with one of AJ's customers, and the gentleman, they turned him down, and he goes, "What can you do, Lisa?" I'm like, "Okay, let me look at it." And so they were using all of the seller's money to buy down the interest rate, which eventually it's going to end up being market. And so I said, but he wanted his payment lower. And I said, well, what if we go ahead and do market? I had $23,000 to work with, and the builder was allowing them to use it because their lender couldn't do it at the time. And so I said, let's just pay 1.5 points. We're going to use $15,000, and we're going to pay off your car loan because we had $23,000. So we paid off the car. We were going to pay off the car loan because the interest rate was only going to save him, $200, and it was going to go up and up. And this way, he paid off $380. So his overall household budget was much lower for a longer term, where that would have been money he lost, except, with a buy down, if the seller is paying it, you get the refund of whatever is it used. But indirectly, I said, wouldn't you feel more comfortable with paying off the car debt? Because when the payment goes up, you're still saving $300 a month. So you're under the budget you really wanted. Your house payment's higher, but your whole household income or budget is lower. But then I said, okay, we can do this, but we have to close July 1. It was due to his credit history. I said, we have to close July 1. Well, then their lender came back and said, oh, we can do that. But I told him, I said, you do what you want, but I wouldn't use the buy down. I wouldn't use it to buy down the rate. I would use it to pay off my car. I said, because you can do that. And so it was helping with qualifying at the higher rate, and also helped it look a stronger loan because I needed to be able to get like an approved accept. And that's the way I was able to get it. Because you can get approved, but if it's ineligible, it just means it has to be manual underwritten, and some loans don't allow that.
So if I have a house that has 2.375 interest, which I do, fine.
Mm-hmm.
And I want to go sell it, and I am operating an assumable on that portion of if they are VA eligible and you are saying that there's a way that they can, the way I always understood it was that my eligibility would be tied up in that. The eligibility is obviously raised, so it's not that anymore, but
correct.
It was.
Right.
And they can transfer the eligibility over to the buyer, but your eligibility is tied up.
Yes, as long as it's a veteran, he has his entitlement. But again, what's your loan amount? What percentage of your entitlement was used? Because as you mentioned, the entitlement has gone up so high that it's really helping where they don't have to have a house sold and still be able to qualify for VA on the next transaction.
Right. Yeah, no, we got it at a great time, and so my house would sell for a significant more than what my loan is, so they would have to get another loan.
Right.
But I'm just wondering if at with 2.375 interest rate on 200,000, what I mean? And
yes.
Another 250.
Yes.
That's 6 or 6.5.
True, but I don't know, because that was going to be a second mortgage for that buyer, and that rate's going to be much higher. because it's going to be on a second mortgage. And they're typically based upon prime plus 1, prime plus 2. So it may or may not be beneficial for them, honestly, if they're putting 250 on a second mortgage. It'd probably be better for them just for you to sell it and pay a little bit of points, and then go ahead and get like a 6.5 or something like that rate, or 6.25. And then that frees up your entitlement, and then they're just going to have an overall better rate. I mean, better payment. But I don't mind, anytime you want to call me about suggestions or way to look at the overall picture, that's really what I do a lot of that. I want to make, it's just not, I'm just not you want a rate and you want a 30-year, okay, here it is, boom. That's not me. I mean, that's the reason I was up so late last night, because I'm really trying to help this first-time home buyer. And I ran into an issue with the private road. And I was going FHA, and we have to have an association on a private road maintaining it. The restrictive covenants indicate there's a private road, and they indicate that the property owner association is to maintain it. It was established just to maintain it. And the buyer and the seller and other sellers don't know anything about this association out there. Nobody knows about it. They didn't even think there was a private road maintenance agreement. I found that and then they went to an agent, and the agent goes, no, there's not anything. So I'm like, come on, there's got to be something. In someone's deed, there's got to be something that's referencing it. So I just went on Vance County Register of Deeds, and I kept looking until I found, no, here's your private road maintenance agreement. But now no one's paying any association. FHA is not going to allow me to use FHA if I don't have the association maintaining it. And this poor gentleman, he's so excited about this property. It's a manufactured home, and so I can't use any down payment assistance on manufactured homes. USDA started doing manufactured homes as of May 5th, existing, but they cannot be more than 20 years old. And this gentleman's is 23, of course. So, but anyway, but anytime, oh, you're welcome. And anytime you need something, I mean, I try to get creative about what can we do to make this work, because everyone desires a house, and not everyone's going to fall into a perfect box. And there's not any loan that actually goes smooth all the way to the end. Lauren and I just experienced that. We thought, oh, wow, this was the easiest transaction either of us have done. There's nothing that came up. No home inspection issues, no title issues. And the young gentleman did an online, he's supposed to do an online wire, but he did an online ACH. Oh my gosh, I felt so bad for him. He was almost in tears, and I was like, okay. But I just literally called. I called and I followed up on a couple of things, and I said, would you just call and just check with the bank, not wait to the morning to get the notice? Check with the bank this afternoon so we can get it reversed sooner than later. So
Yeah, you told me about that. I was like, wow.
I've never had that happen before. And I'm almost to the point of, please go in person to get your wire. Try not to do it online, because, you know, one thing, some banks are going to allow you to go up to a certain amount on the wires, and some banks are not. And some individuals don't need to be doing a wire online, you know. All right, you ready to get started?
Yeah.
All right, we're trying to get creative. We know that we have a lot of buyers that have a house to sell before they purchase the next one. But they're also concerned about selling too early, because then where are they going to live? Because the market, the inventory is lower than it used to be, a little bit better, but lower. And so therefore, they're not sure how long they're going to be homeless, or if they're going to be able to replace that house at the price that they're comfortable with. So that's the goal today. And so I'm just going to go, this is just bridging the gap. So we're looking at, will a seller accept a contingency offer? There's times they will. I'm seeing that a little bit more lately, where they're willing to do like a 45, 60-day close if they can speak with the listing agent on my buyer side, on the seller side, and just see, how long do you think this house is going to be on the market? I'm seeing a little bit more contingency offers. And then it says, what is going to be the source of the down payment if their house isn't sold? Because so many people are rich in equity, but not necessarily rich in the assets of cash to buy the next house. And so we're going to go over that. Down payment assistance for repeat buyers, and will I qualify before my home is sold? And who do you call first? That is going to be your agent and then me, because we just need to get creative and just see. And this is not going to work for everyone. It's just, it isn't. I'm working with a gentleman, a blessing. He's trying to buy a $1.6 million house and sell his for like $700,000, but he owns the house, his existing house, free and clear. I've got it worked out with the one program, but it's going to cost him $40,000. I'm trying to go a different way if I can encourage him to follow some of my steps, but sometimes they need a little bit more encouragement. All right, so then we're going to talk about home equity line of credits, bridge loans, down payment assistance, borrowed secured funds, because borrowers do not realize this, and then grants. And I can't really tell you a lot about grants, other than Federal Home Loan Bank provides grants to certain banks. I don't even think it's all banks. I think it's depending on how many areas they cover. I honestly don't know how the bank selects to be able to do that. We do not have those type of grants. So if you hear about a grant of $10,000, $12,000, we do not have those type of grants. We do have some. Fannie Mae has, if your income is under a certain amount of the median household income, average median household income, then they'll allow you to get $2,500 towards closing costs. But a lot of these, some of them have to be, income has to be an average of 100% of the average median income. Johnston County and Wake County, that's $122,300. But a lot of the programs, okay, a lot of the programs are, it has to be 80%, which in Johnston County and Wake County is 97. So that's where it gets tricky. And when I was teaching the class behind the scenes is when we started out, we had two counties, Wake and Johnston. And basically that's where our buyers were really kind of buying it. Now for it to be affordable, and in my class about that, to be affordable, it's 12 counties, because you got Harnett, you have Nance, you have Nash, and you have Vance, and all of the surrounding counties, just so the customer can get out and buy affordable housing. But I can cross the line to Harnett County versus Johnston, and my income limitation just dropped $30,000. So it's to the point that I almost have to say, can you please stay in this county and I can help them? I mean, there's no crossing over 2 inches. It's just literally. So that's about the grants. And then we're going to go over the line of credit or loans on your existing house. I'm going to highly recommend that as soon as you talk with a customer and you find out, do you mind if I ask how much do you owe on your house? And you'll know, and then you'll also know about the equity. I want to talk to them as soon as possible. Anyone that has a lot of equity in their house, I highly recommend that they set up a home equity line of credit. And the reason is because some lenders are going to allow you to go up to 90%, and then some may not. And it's cheaper to do it and better to do it ahead of time and go with the maximum you can go. And then therefore, if you get ready to sell your house, you already have access to that equity and you're missing out. So let's go over that a little bit. So typically it's 70 to 80% of the value. And then we're going to take, and then I mentioned that some lenders will go up to 90 of the appraised value minus the mortgage balance. So that's going to be what they owe. So for example, you indicated 200 and 250. So that's 450. So you could probably go, there's certain banks that will offer 90%. Well, you're thinking, well, I don't want a line of credit 250 or whatever what would that be? About 300 and something total. You may say that I don't want my first mortgage and my line of credit to be so high, but you're not charged if you don't use it. So it's just there, and it's better to get it up front than when we're trying to, everyone's found a house, we're trying to get the home equity, we're trying to close on time. How is the lender on the home equity side going to consider equity, qualifying ratios and so forth. So the sooner we can get the individual to set up a home equity, the better. That means that that becomes now a more of a liquid asset to them. So your interest rates are going to be variable rates mostly, which is based upon prime, and some of the lenders may offer a fixed rate conversion option, meaning after 5 years you can convert to whatever that going fixed rate is on that particular product. They are going to be higher. A lot of customers think, oh, well, I've got a 6 1/4 on the new house, but on my existing home, you're going to say that rate's 8.5, but we're using it for short-term money. We're not using it for long-term money. The closing costs and the fees, there's going to be some, I mean, I offer them, but I'll be honest with you, our fees are a little high, but if it's the product they need and the only thing that they can use, then yes. But if not, I'm going to refer you to lenders and no, do not charge much. And that's typically your banks. And therefore, it's most of them are going to be somewhere around very little cost or about $1,500.
I think some of the questions we get with regards to the HELOC, so is there an appraisal process that comes along with this? I'm assuming, like, can you talk us through that piece and what prepare the client for that they may have to deal with? And then is that appraisal something that we have to overcome?
Possibly,
Okay.
possibly. So that's going to vary because it depends on what excuse me, sorry about that.
Go ahead.
It depends on what the loan to value is on the first mortgage and then what the combined loan to value is when you add those two up as far as the value. It could be a desktop appraisal. It could be a drive-by appraisal, or they may want a full appraisal. If someone's doing a high line of credit, like 250 to 500,000, and most cap it out at 500. I've never had anyone get one more than 250 actually, but that's going to really determine the appraisal that they're going to want. And the appraisal that you do versus the appraisal that might be a desktop appraisal, you might get higher or lower. You guys know what that, I mean, it's literally an opinion. If your house is sold, so if they already go under market and they're going, oh my goodness, I found out I need to put this much down to qualify. If they're already under contract or their house is sold, most lenders will not allow them to do a home equity line of credit. Most lenders are not going to allow them to have a house on the market and do a home equity line of credit because they're not going to make any money on that loan, because they know that if it's for the purpose of buying a house, they're probably only going to earn interest for 30 to 60 days, you know, as far as the home equity. So the sooner they can get the home equity or at least talk about it. I know enough about some of the competition home equity, and I can give them the questions to ask, because sometimes it's literally educating them to ask the right questions. And then the payments may be interest only. Sometimes when you're started out sooner, the payments may be interest only that I may use for qualifying, but some of them may have principal and interest. It's going to depend on the lender. And then the qualifying payment, for example, one of the lenders that allows you to go up to 90%, which is one of the lenders that allow you to do that, they're going to qualify you typically at 1.5% of the amount you're setting it up for. So if your loan amount on your home equity is $250, they're going to take 1.5% of $250 for the qualifying rate. You want to get this going before you get started on your other loan for the other property, because it could be that they are just going to discover that you applied for another mortgage and may question, you know, what's this other mortgage inquiry? Or are you going to have a payment? So again, the sooner the better. We can work it out, but it just makes it easier for you and the client and the loan officer to make it all work out. And better for the customer, they may get better terms. And then qualifying for the new house. So what happens is you do have to qualify for the existing mortgage, the home equity line of credit, and the new mortgage. And so that's that's the direction it needs to go. Then we're going to get over here, and it says the HELOC is paid off. So the beauty of it is the HELOC is paid off when they sell the house. They sell the existing house, the HELOC is immediately paid off when they sell that house. Going to pay off the first and pay off the second. The true benefits of it, let's get over here to the benefits. It does not affect the rate of your first mortgage on your purchase. But some people do not realize we refer to it as a purchase money second when you're doing a second mortgage along with the first to buy that house, to buy the new house, because they may have to do that and then sell the house and pay off this second mortgage on the new house. I'm referring to the home equity on the new house, like you're doing a first and a second, like a piggyback, 80-10-10, 90-10-10, I mean 80-20. Now what happens is, what some people don't realize is it could cause your first mortgage interest rate to be an 1/8 to 1/4% higher by doing that second mortgage, because you just made the exposure to the bank 90% versus 80%. Okay, so think about that. But this doesn't always happen. If they're putting a larger amount down and their first mortgage is going to be under a certain point, that's different. But we got to consider that. So that's one reason that's not the first direction I go. I go to the direction of the existing home and the funds available. So if they do the home equity, they also have the funds ready for the due diligence. They had the funds ready to do any repairs for you to list their house. And they also are able to pay off debt for qualifying on the equity on the new on their existing, and the payments are often interest only. So they're not really looking at a large payment. Correct. Mm-hmm. Yes, but honestly, sometimes just 20% down, the rate may be higher if you just did 19%. So believe it or not, it's just because we're still a little bit more, I don't really know. I mean, it didn't used to be that way, but it's changed. And it's like, if you put the 20% down, sometimes I'll say, why don't you put 18% down? And then after closing, you just pay it down, or put down 15%. And then you can recast after 10, if you do a lump sum of 10,000, and you can get rid of private mortgage insurance. But so that's why the behind the scenes of what I do as your loan officer is a lot more than just, oh, you want this, oh, you want a second mortgage, you want to put 20% down. That's not me. My thing is, why don't we do 15? You're going to get a better rate, and then maybe the other 5% you would come out better to pay off the debt. You know, I structure it that way, and sometimes it helps them with the increased house payment for budgeting purposes, because they've paid off debt. So, any questions about that? Are you learning anything, or is it just? I get very detailed in my training, and it's not like I want you to understand it, but I want it to be like, oh my God, I remember something about that. Call Lisa. So then we're coming in. This is where I was talking about the purchase money second. That is going to be on the new house, and that's where I was basically. I've already mentioned some of that. Sometimes it's the 80-10-10, 75-15-5. That's the better deal. The 75-15-5. If we can get that mortgage down to 75%, that second mortgage probably is not going to affect that interest rate. But again, it depends on the client and what we can do. And then it's going to combine the loan to value with the vary of the loan product first. So the loan to value, I keep using you on the 200 and the 250, but those numbers are stuck in my mind. So if the loan to value, what we're doing is we're taking 200 on the first mortgage, and then 450 or 300 on the second, or whatever we need there, or 200 on the second. We're going to add those two, and that's combined loan to value. We divide the balance of those two by the value, and that's how we understand. That's how the combined loan to value is considered. I wouldn't want your job either. Right. And then you're going to set up the first mortgage for the desired amount you want when your house sells. That's our goal. And then the second mortgage is the difference between the down payment and the purchase price. Payment may be based upon variable rate or fixed rate terms, as we've already gone over. Interest rates on the first mortgage may be higher, which I mentioned that. And you'll have to qualify for the payment on the existing house, the home equity, and is on the existing house, and then the first and the second on the new house. May require an additional appraisal. So we get an appraisal on the first mortgage, but some of the lenders that offer the purchase money seconds, and again, I can do that, but it might be a little more expensive, but it might be the best thing for the customer too. But that sometimes that lender doing the second mortgage will not accept the first mortgage appraisal. because they're like, we did not get that directly from the appraiser. We got it from you, and so they don't consider it their appraisal. So there's times I've had that issue, but a lot of times it may just be a drive-by. And then the closing on the date of closing. So you're going to close on the first and the second, the same day of closing. So you'll be closing with the first mortgage and the second mortgage. The attorney may charge you a little bit more on that. Most attorneys don't charge a whole lot for that second mortgage. It's kind of a breeze to get through those. Okay, disadvantage. Funds are not available until closing. So if they need due diligence money, if they want to pay off debt, if they want to do repairs, they don't have that equity up front to do that. So that's the disadvantage. I used to do, this was so popular years ago when you could do 80-15 FIs really easy, and the rates were down at, 5.7, 5.7% and so forth on the second mortgages. They were a lot being done at one time. So now, this is my little bridge, and we're going to hit bridge loans. This is where your money is. This is where the costly effect of doing this is, okay? So with that, there's several bridge loan options. So I would be looking into what is the best one for you, because I have a few. And they change the underwriting guidelines from time to time. So it's literally, I would just, even though I'm familiar with the products, I would be going back on the day that I'm talking to that particular client and make sure that it fits every guideline I need for that particular customer. But typically, they will only go up to 75% of the value. So they're going to go up to 75% of the value. Part of that money is to pay off that first mortgage, and then the rest is, considered equity to be used for the bridge part. The funds may be used to pay fees, pay off debt, $35,000 in for home improvements or down payment. 35, I was just using that as a miscellaneous number there. No payment or out-of-pocket cost up front, zero interest typically. So far as zero interest in collecting for payments during that time frame, okay? Because what they're doing is they're selling the house to the lender offering the bridge loan. But there's a contingency that it has to be sold by a certain time. And then they're going to hold back 6 months of the house payments out of the equity, okay? That's what helps us not count the payment and the new loan, okay? So that's what helps us not have to count that mortgage payment, but it's costly. But again, if that's what your customer needs, that's what we have, and some people don't have an issue with that because they know that eventually they're going to buy the house that they want. This particular product, I have to put in here, it's not.com, that's the lender, and must refer to their guidelines, of course. And then so the realtor, you as the realtor will still get your compensation. Let's say you have a house and it's been on the market and it's not selling, and the buyer or the seller is willing to do this now, and you're thinking, oh my goodness, we're going to go to open door, we're going to do whatever the sources are. And you may think, and I don't know about those sources, if you're still getting your full compensation, but with this, you would get your full compensation. So you can still list that property. You're not going to lose that listing, okay? You'll still get your compensation. So you're going to work with the preferred agent or lender. That's step one. You're going to learn about tying it up and figuring out what's going to be right for them. You're going to apply for your new mortgage, because we need to make sure you're going to qualify or what you're going to need. You're going to confirm eligibility, tap into the cash. You're going to make a competitive offer, because now they don't have to worry about doing a contingency. And then you're going to maximize your home sale, and you're going to sell your house, and your agent's going to get, and you guys will get paid. Now, this is where it becomes tricky. So this is an example. Again, outstanding mortgage before outstanding balance is an additional lease. For this example, the balance is 100. The estimated mortgage payment is $2,000 on the existing. And then we have estimated list price on the existing home, happens to be your $450 that I've already been using. And then estimated sales price on the new house. So this is where you're going to get costly. So the approximate bridge loan available going up to the 75, paying off the 100 is 226. Then we're going to take out 6 months of PITI. Therefore, we don't have to count the payment against the borrower. And that's not on loan products. That's on Fannie Mae, Freddie Mac. We have to make sure, I think it's Fannie Mae actually. We have to make sure that they're qualifying for that particular loan product on the first mortgage. Then they're going to have fees associated. So the contract fee on the old house is $10,000. The estimated bridge cost is $1,850. So funds for the new house available is $202. So they're going to make a contingency offer. They're going to fund a down payment of up to 50% on the new house. So therefore, the seller's feeling really good that he's got a strong offer, covering the cost of closing for the purchase, home improvements, paying off moving expense, paying off debt for qualifying. So it frees up that cash. But see, this is where if they had freed up the cash earlier, you wouldn't be stuck with all these fees. You know, you've got $1,200, $1,300 fees in this example. Okay, so you're not stuck with all those fees, but at the same time, this payment's not considered. You don't have a payment. So what works best for your customer? And so if they open the home equity on the existing house and we end up not using it, that's fine. You know, no, it's not going to go, there's not a payment against it. Jumbo, they will consider the payment, but most of us aren't going to be hitting too often that jumbo loan amount since they've increased it so high. So then we already talked about the grants, and then now we're coming to some special products that we have. And I really have been digging into this lately just to help my first-time home buyers that their income limitation is too high for their county. And it's just, I started originating in '87 and in the business in '83. And I was known as the first-time home buyer queen. And I don't mind helping the first-time home buyers, but I want your other business too. But I remember how difficult it was when rates were at 10 and 8 and so forth qualifying. But I think it's just as hard now because the values have gone up so high. And some of the counties, their income limitations for home buyer products hasn't gone up to meet that values. So I think it's a bit of a struggle, but there's more products. So it's a little bit of a win and lose. So this is a movement mortgage boost. This is special for us. I don't know if other lenders offer something and they just call it something different. But we're going to use an FHA loan. And then we're also going to do the down payment assistance. And we can do it for 3.5% for their down payment. Or we can do it for 5%. So they have 3.5% for their down payment. And then they have the rest of the 1.5% to be used towards closing costs. There is a lien on that second mortgage. It's not going to be forgiven, and there's a payment required on that second mortgage. It's going to be 2% higher than your first mortgage. So if it's 6 5/8 on the first mortgage, the rate on the second is going to be 8.625. The payment's going to be calculated at a 10-year term. So you're really looking somewhere around $150, $200 on that second mortgage, depending on where the customer is going. But again, it helps them. They can pay it off earlier and not go through the whole amortization period. It will save a lot of money. But the loan amount is up to the maximum for FHA. So, you know, some of North Carolina housings, of course, 90 is the sales price and so forth on certain ones. There's no income limitation, nowhere, not any county. Not limited to first-time home buyers. If you've got one buying and they don't have the funds out of their house, we can do it as long as they qualify. We can use this program. MCC allowed, I didn't take the time to correct that last evening. MCC is no longer offered on North Carolina housing. And the debt to income ratio, check that out, 56.99. As long as, I'm not going to be able to get 56.99 if someone's credit score is 620 or 640 or whatever. But non-occupying co-borrowers are allowed. That's not always allowed with any down payment assistance, but they are here. Your maximum loan to value, which is your minimum down payment, to go up to 96.5. Manual underwrite is an option. So that just means that we're not going to get an online underwriting system approval, but we will use alternative doc, and just go through the standard manual underwrite, but the ratios are going to be really tight. You're not going to be able to go up to the 56.99. 1 to 2 units are eligible. Can you imagine doing this and buying a duplex and occupying one? Because FHA allows you to go with a 3.5% as long as you're occupying a duplex unit. That's one of the only ones will allow, FHA will allow it. Manufactured homes, this is what's helping me with one of my customers. We will do a 1 unit only, which I guess triple Y. Yeah, 650 or triple Y, but 650 minimum credit score. So there's some restrictions there. This is not, pardon me?
They are massive. They are massive.
Right. I had some customers like, oh my goodness, this is great. And remember, modular homes, we treat it as a stick build, and manufactured home is different. So keep that in mind. We treat that as a stick build house. So this is really helping because North Carolina housing will not accept manufactured housing unless it's brand new. USDA is now accepting as long as it's not more than 20 years old. So that's helpful. But some of the more affordable ones is a little bit older than the 20 years. So, and then last night I was working on another one of my products that we offer and got down to the very last, oh God, this is gonna work. He's under the income limitation. Oh, yay. Manufactured homes not available. I was like, I should have looked at that first, but I just really thought it was gonna be available. So there is a 1% origination fee, just like North Carolina housing. They charge 1% origination fee. We charge it on this. There's no option of us reducing that at any point. We cannot do any price exception or negotiate on the rate of this. So they can buy down the interest rate with points, but there's going to be points plus this. And then this is the one I was working on last night. We got all the way down to the bottom. I'm like, yay. And then it said no manufactured house. So then we've got, this is a 4% down payment. No income limitation on the 5% down payment with movement boost. This is 4. You got your minimum down payment of 3 though. Mercy. So what you've got is a minimum loan to value is going to be 80. So they can put down money and then borrow, borrow the 4%. It's a 30-year fixed rate. Minimum score is 660. Debt to income ratio, as long as I can get an online approval, and that's tricky. I mean, it's just like moving numbers around sometimes, or 50%. So as long as I can get an online approval, we can go at 50%, which is really nice. MI is required. It's going to be the FHA MI, which is nice because it's not always priced off the credit score. And then again, mark out MCC. And then the down payment assistance is going to be the 30-year fixed rate up to 4% of the lesser of the sales price or the purchase price. It is a second mortgage. It will have a payment, but it's interest-only payment. And the second mortgage rate is the same as the first mortgage rate. So you don't have that bump. So the payment's going to be less and you don't have that bump. And then the rate may be bought down and it does not have to be a first-time home buyer. This is where we compare North Carolina housing, movement boost, and dream home. So these two products can be used if they haven't sold their house, okay, and used, for the down payment and so forth if they haven't sold their house. This is a way to go for these two. And it just kind of breaks down the underwriting or the differences. And then North Carolina housing is the 15,000, and then they have the 3%. And it has to be a first-time home buyer for the 15, but the 3% no. But that rate's higher. So even if they don't need, quote unquote, need the 15,000, I'd much rather them go for it because it's going to be at a lower rate. And then there's income limitations. Sales price limit is 490. MCC, we can't use it, but it's not available. And it can be used on all products, minimum score 640. And there's no movement on that. And there are income limits on North Carolina housing, but not necessarily on the one on the 3%. It's kind of like a really high income limit, like 140. It's not like the 120. And then the down, we already discussed the movement mortgage and so forth. I was just putting it at a glance for you. And then this is the big, this helped one of my customers. She was like, oh, I'm not going to be able to buy. When I talk to your customer, I really ask a lot of information up front because I need to know my options. So if something hits, I need to know my option. So when I'm referring to borrowed funds, that is actually borrowing against their 401k. Because a lot of people are like, I don't want to touch my 401k. Well, if you do, and you're younger than 59 and a half, you are going to have to pay a penalty and you're going to be paying tax. But on the borrowing, you're not paying a penalty or tax on it because you're borrowing against your own asset. I do want you to check. I want your customer to check pros and cons of any of that, borrowing against their retirement, but that helps us with down payment. And typically the term is 4 to 5 years to pay it back to the back to your 401k. We do not consider the payment on that loan as a debt because you're paying yourself off. Some programs will, but most 99% of them don't. And then so far as if it's jumbo, it's a little different. And do not have to pay taxes on the money because you've taken it out and you borrowed it, and you're borrowing against your asset, and the payment is not considered. Other secured debt, maybe refinancing a car, or something along those lines. And so here is the Zoom Costa. This is one of those where it's kind of like the true bridge loans. They'll go up to 70%, and they'll go off of the appraisal. But if you end up selling the house for more, they will then give the seller that equity that you sold the house for more. So the 70% is based off the appraisal at the time. They are able to do upgrades, do repairs, and then you're able to sell it for more. They get that equity back. I mean, it's like they're just going to give you the cash out equity. Pay off debt, move, and then here's the lender and agents. This is the benefit. No more existing mortgage, may free up VA entitlement, FHA options, no more taxes, insurance, and HOA during the time frame because they're going to use part of the equity of the loan to pay off 6 months on their payments. And then the agents win because you don't have to worry about your customer being homeless and you get paid. And I think we have gone over most of that. Now this is the one that's a little bit more costly. This is as is, 400,000, pay off the debt. But when you're coming into the cost, we have to be careful about the cost because on this, now this is considering your commission or commissions paid out. So they'll pay out the commission out of your proceed, out of the equity that they use. This program is 20,000. The other program was like 10. So we need to figure out what works best for your customer. And so this is just kind of showing you some of the proceeds. This is really detailed. You and I know this, and that's it. Any questions? That's a lot. That's a whole lot. And I don't mean to be overwhelming with it, but I just want you to. Oh. Thank you. Thank you.
So what would you say are top 3, like starting point? We have somebody we're going down this path with a client. Top 3 things we need to ask or be aware of. Like what we don't want to happen is send them to you and every one of them be like, this isn't gonna work. This isn't gonna work. Like what are some top 3 qualifying questions for us to know or ask?
As I mentioned the other day, student loans. Okay. Number one. I don't think, Shelby, you weren't there. Were you there? Okay. Yeah. Number one. That is really a concern for me. I don't think and just tell them you're asking because of all the news media, and that it's already affected some buyers, and you're just trying to get ahead of the game for them. But they need to go in and check because LaShawn, is it LaShawn? Yeah. Okay. So they need to go in and just check their student aid information, not just go, oh yes, it's in forbearance. It may not be. And they could be 120, 180, $10 million people are behind on their mortgage, and 5 million are in default. And default means it's already becoming a collection. So please, because we don't want them under contract, paying due diligence. And I'm having to really look at I'm getting to the point where I'll do a soft pull only if that customer says, I don't know when I'm going to buy, so forth and so on. But when they get started and seriously buying, I want a hard pull credit report, because what if something is not reported and then they're trying to go under contract? I personally would not accept an offer with a soft pull. Not with this situation of going, because you don't know which one hasn't updated those student loans. And I honestly don't know if they just report to one bureau or not. Some of the programs that we use, I cannot do a soft pull and get a pre-approval for you. It requires a tri-merge and a hard pull. So that would be the student loans. It would be, what's your source of income? Hourly rate paid individuals. We just can't say, okay, you work 40 hours a week, here it is. That's considered variable income when they become hourly rate. That's been a major change. And so we're going to be looking at, we want the employer provide us a letter that they're guaranteed 40 hours a week. It's such and such per hour, which equates to the annual. It has to be that specific. Somehow either on a verification of employment or a letter and then a verification. And then they're going to look at, underwriting is going to look at their year-to-date earnings. And if it doesn't equate to what it would have been at 40 hours, because there's sometimes that they do not work 40 hours, believe it or not, and they don't always get PTO for that. That's become a little bit more difficult. So and just tell them to tell us everything just to tell us everything, because it's going to be discovered. Ask if they have any down payment. It's just, do you have anything for down payment? I don't know where you guys feel like you need to draw the line on the questions you ask.
No, that's really good. I think it was just, is there anything that would raise a red flag for us to say, okay, we need to maybe not go down that path? I was just trying to think.
Right.
Any not quick, but easy-ish pre-qualifying questions for us, for lack of a better word.
Let's cash on hand in a safe at home, $5,000, $6,000, $20,000.
Okay.
Oh my goodness, they need to start putting that money in the bank in partial amounts, and it needs to be seasoned. Okay. So they need to get started, and I don't mean 60 days because we normally look at 2 months. But if they put it in one account and transfer it to another account, that may be 90 days at one, because one bank statement may go to the 15th or the 20th, and the other one's 30 days. And then all of a sudden I've got 45 days and I need another 2 bank statements. Now I'm 90 days out. Okay. So that's become a really big thing now. I mean, I'm working with 2 right now. And then they tell me, oh, I have this. And I'm having to be more specific about my questions.
That's why I'm asking. I feel like we're getting along the lines with a lot of people right now, and all of a sudden it's like, well, then it came to light that actually this. So we're just trying to be better at making sure we're asking the right questions to help you when we're bringing people to you in this situation. Because a lot of times when we're having this conversation, it's on the cusp of trying to write an offer that's going to be contingent, and what about this? And okay, well, Lisa says if you have this, we can probably go the bridge loan route, and then we write the offer, and then we get stuck because we didn't know to ask this or this. And it was like, once you guys really pull back the curtain, then we find, okay, if we would have just started with that, like, do you have $20,000 to put down? And they're like, yeah. And we don't say, is it a mattress or is it a bank account?
Right. And how long has it been in the bank account?
I just went through this for some buyers because a lot of work on the side. And so cash on hand, they took very literally, like, when can I physically get my hands on as far as cash? Then it came down to, oh, we haven't been able to track it because you've been doing all the side work, but you haven't been depositing it. And so Lord knows don't go drop $5,000 in there right now.
Right.
How do we determine that? So I think that's what I'm saying. Like some of these quicker questions, for instance, if we're looking at doing the bridge loan, do you already have an equity line of credit? We probably need to know that before we go down this path.
I would really want a home equity line of credit I really think they need to do it right away. As soon as you start with them, I don't mind calling, I don't mind talking to them, and I can tell them the benefits. But if they have a lot of equity, I'd really like them to do a home equity. Right. And then if we need to go bridge, they can still, I would still recommend they apply for it as soon as they know they're even interested in buying a house. Because again, it makes the whole process a little bit better, because if those the lender for the second mortgage, they may say, oh, why are you using this money? And if they say to buy a house, they're going to go, okay, we can't do it. And some will allow it. But if we do it ahead of time, we already know. And they're not, and then the lender doesn't know anything about a potential first mortgage, be 6 months, 9 months, whatever, down the road. But if that has to be considered, then they've got that payment to qualify along with the home equity. If they do the home equity and we decide to do the bridge loan, that's fine. If they don't put anything on it, we just close it and do the bridge loan. That makes sense? Because it's cheaper to do the home equity.
Right.
But I can go over that with them.
And my question would, I feel like, so I already have an equity line on my home, and we just keep it open for cash on hand, for lack of a better word, if we need to do something. And this is my ignorance for not knowing, but this goes to show, if I was planning to do this, I don't have to, like, we opened the equity line 7 years ago.
Yes.
I don't have to get a reappraisal to pull more money, do I? Or,
you may.
Okay.
You may. If you're going to the top, I recommend, if you can, to go to the maximum. Now, your rate may not be as attractive, but you're not really using it. It's there for the purpose of, I want quick cash. I don't want to take money out of my brokerage account. I don't want to take money here. I don't feel comfortable in paying cash for this because, you know, I just rather put it on the home equity and make larger payments, whatever the situation is. But if you can go to the higher, then that way, if you get ready to sell your home or you're wanting to invest in some other real estate, whatever the reason is, and you just need some quick cash, that home equity is really good. And so, and also, if you took your loan out 7 years ago, you may only have a draw period of 10 years that you can only draw on it. So you'd need to check and see what your draw period is on that. But, so, and then the other thing, I thought of something else, gift funds, ask if they have any sources of gift funds, but I go over all of that. I ask them whether they need the assets or not. I ask them to tell me what assets they have. Because if you call me and say, Lisa, the seller, what are we going to do? We needed the seller to pay closing costs and now they're not. Well, I basically already have a backup plan or something that I can refer back to and figure something out for them the best I can. So, let's see. Oh, this is what it is. What area are you interested in buying? And it's because Johnston County, Harnett County, Nash County, Vance County, I have all these different income limitations. I'll give an example of where a client wanted to be in Harnett County. It was also looking in Johnston County. So please stay in Johnston County. And because in some private mortgage insurance, if they're at an 80% income limit of the average median income, and that's provided to us through Fannie Mae, Freddie Mac. So in Johnston County, it's 97, and in Harnett, it's maybe 50 or something along those lines. I don't remember exactly. But my customer, because he would, if he bought in Johnston County, I could give him a discount on his private mortgage insurance because he wasn't over that 80% limit. He went into Harnett County, if you're not, private mortgage insurance is $200 more. So that's where we need to, I need to be able to know what they need, and then I can say, hey, you know, I know Harnett County might be lower, but this is, unless we're going to do this other program, it's going to cost him more money. And then sometimes if a house is lower and they fall in love with it, it's fine. But if they're trying to make decisions, just know that what can affect that payment is just crossing the line sometimes because of income limits. So are we ready to go, or do you have any buyers? Again, I hope it's helpful. Again, I'm sorry I get so detailed, but I just want you to kindly, if I just came in here and said home equity, 20%, you know, and then a lot of people think bridge loans, but a lot of times we use home equity as a bridge loan, but it's really not a bridge loan. It's just bridging the equity. But that's everything.
Thank you so much.
You're welcome. Thank